And today we have a very special session for all of you, which is on investing in SIP, but in debt funds. So it's extremely important to know that the SIPs can be done not just from an equity perspective, but other asset classes also. So today we are going to learn a little bit more about that. And for that, we have put forward a small presentation through which medium we will be discussing about the benefits of doing SIP in debt funds. So I hope you're able to see our presentation, and let me straight away get into the sessions. So what is SIP in debt all about? I think it's important that SIP as a concept is well understood by everyone, and that's the reason why we see a lot of SIP happening in the industry today, and people have made it as a one of the favored routes of taking monthly exposure into the capital markets. The capital markets of both equity and of debt. So we all understand equity, and we also try to, through the SIP route, take few mini steps into the market. But today's session is about doing SIP in the debt funds. So let me first try to address some of the investor questions, which it sort of raises everyone, because we look into it and we say that how do I take advantage of market volatility? How can I avoid buying more when the market is high instead of buying more when the market is low? And again, SIP, because of its nature of doing it in a certain asset class which is volatile in nature, it will also swing with the market movements. And more or less, eventually, it's about how do I become a disciplined investor? Can SIP be a solution to all these questions? Yes, it is. But we always look at it from one side. Today, we will try to look at it from both the sides. I'm going to start off my presentation today with a news clipping which the business paper Mint does year on year. This is called the allocation quilt. I'm going to zoom in a little bit for your preference. And let's focus on the 2020 article, which came out at the end of 2020. What they had done is they have compared 10 different investment products of different asset classes: gold, real estate, credit risk, corporate bond, T-bill, GSEC, international funds, large cap, mid cap, small cap. And they have done this comparison over 10 years. Each year, what has been the best performance to the worst performance, and that's how it's rated. So 2011, gold was best, 12 mid cap was best, 13 international products were better, 14 small cap, credit risk was great in 2015, 16 GSEC, 17 small cap, 18 gold, 2019 international, 2020 small cap, right? Now, this is very good to look at this data because this is past. And we all know that, no one is able to invest like this. Most of the times, what is the best performance? We will probably go back and look at it and say, okay, this has really done well, and we would start looking into it. So what is most important here is actually to look at what is the CAGR return of all these categories over 10 years. If you would have invested, say you had 100 rupees to invest, and you would have invested 10 rupees in gold, 10 in real estate, 10 in credit risk, and so on, then what would have been the combination return, the CAGR return across asset classes? So for your benefit, we did that calculation ending 2019, which is starting 2010, ending 2019, and then ending 2020 means starting 2011, ending 2020. Now you can clearly see the returns, CAGR returns, and we have listed them from least to the best. Now, of course, we will look into multiplicity of the returns. So I am going to help you with doing some color coding. So I've highlighted gold for you. I've highlighted GSEC, which is the government bond index. We have highlighted real estate for you, corporate bond, and large cap. Large cap is the Nifty. Now, what is most important here is, if you look at large cap, right? If you look at corporate bond, if you look at real estate, if you look at GSEC, these are inherently different, 4 different asset classes, and gold is the 5th one, right? Now, 4 different asset classes in 10 years period is actually giving you similar return, right? They are all between 8 to 9%. If you look at in GSEC in 2020, in fact, it gave a higher return than large cap. So whether it's equity, whether it's bond, whether it is real estate, whether it is GSEC, over a longer period of time, all the asset classes probably are now delivering similar return. Although we know the characteristic of each of the asset classes is very different, right? And then gold, of course, it is a hedge product. We all understand that we buy gold at the time when other things don't work, right? But what is most important is that we are looking at a different set of data now, where as you keep your money invested over a longer period of time, probability of you getting similar returns over different asset classes is increasing, right? So, and gold, we all know, we have always found occasions to buy gold. We just had Akshay Tritiya going. I'm sure a lot of people would have bought gold, even though the gold shops were closed. We would have found a way to do it. We buy gold during weddings. At least we have so far. Maybe in future we don't know. Each to its preference. We buy gold when we get into a new house, or we celebrate with some gold as a sentimental value when we have a new member in the family. So in the hindsight, if you look at this, the next chart that we are going to put up about the gold prices. This is a chart which is dated from 1925 till 2019, and now in fact the gold price is 50,000 per 10 grams in India, right? So over a period of time, while a lot of you might be looking at it and saying, wow, this would have been a great investment, I want to ask a very different question to you. Have we or have we not done a transgenerational SIP in gold? My family surely has done, because I know my mother bought a lot of gold over a period of time for every occasion that she found. I know my grandmother bought a lot of gold over various periods of time. I know her mother would have done the same thing, and so on and so on, right? So we have actually, without knowing, we have done a transgenerational SIP in gold, correct? And the benefit of that is about accumulating it, and actually now looking at the price and saying that, wow, if this gold would have been carried on in our house legacy today, then it would have been valued at something very different. But if you go back and look at the process, we didn't matter what the price was. Our families, it did not matter what the timing was. It did not matter what occasion was. We only remembered to put something into gold because we believe that as an asset class, it would deliver over a future period of time, or it's like a safe asset class, right? So think back again, have we or have we not done a transgenerational SIP in gold? I think we have. So while we look at gold from a perspective of Akshay Tritiya as a day to do an investment, we are already doing SIPs in equity, probably monthly or your salary days or maybe your birthdays. And of course, we've been always doing recurring deposit over a period of time or bank deposits. So when we are doing 3 asset classes, why are we missing out on the 4th one, which is integral part of any investment cycle, which is debt? Why not a SIP in debt, right? Because if you look at the benefits of SIP, it's very, very similar, right? We are looking at disciplined investment. We are looking at volatility benefit. We are looking at We are looking at rupee cost averaging. All of that is coming. Uh, all of that is coming out as an important tool. And I'm sure you guys must be wondering right now that, look, when we look at debt fund returns, compare it to equity fund returns or any other products, we see that it does not, probably at times does not give the same sort of returns. Then why are we talking about SIP in debt? I think over a course of the presentation, you're going to see different data points, which probably would actually give you an insight of how debt is operating in the country and how returns are being made across different products. But we are not going to get into too much on funds today. We're going to look at it from a concept point of view, right? And of course, the add-on benefits of SIP in debt is that it can be used to achieve both short-term and long-term goals. It will be used to reduce portfolio volatility. It will be good from an asset allocation point of view. And you can benefit from the change in interest rates. The change in interest rates is an integral part of debt, where a higher regime or a lower regime, it needs to be understood in the right way to make money. Right? So let's get a little bit more on goals now. Now, what are the goals in life that we have? Of course, we are saving enough, we are investing for some of the longer term goals. Longer term goals for someone is, say, a house, maybe a car, family, vacations, weddings, all of that, which could happen, or education of the children, or retirements. These are long term goals. And we have talked about a lot of these goals in some of our other presentations. Maybe we can go back to our previous session videos or on our YouTube page and can look into those videos, where we have spoken about long-term goals and converting them using products. And largely, a lot of times we do talk about these long-term goals, keeping equity investments in mind. But today we also would look at certain short-term goals where probably you can use debt funds more effectively. What are these short-term goals? Maybe a good quality phone could be a short-term goal for a college kid. Maybe a travel coming up in the next 2 years, a world tour could be a good short-term goal. We are all in pandemic right now, right? And how many number of laptops are you going to add every year? Unfortunately, last year, again this year, if you have to work from home, you have to upgrade your infrastructure at home to work. Maybe some gifts that you want to do, some expensive gift that you have to set out, that there is an important birthday coming up in the family, somebody 50th birthday or somebody 75th birthday or some anniversary just around the corner, maybe 2 years against the line, and you're thinking that you want to give something, some medical emergency. Always good to have some money invested as a medical emergency. And the good part today is that you can give your name for the goals on the investments that you do, right? Mira said we have goal 6, where you can put the name of the goal for what you are investing. So you'll always remember for what you're doing. Maybe a home renovation coming up in some time. All these are short-term goals. And usually, when we look at asset classes which are long-term in nature, say equity perhaps, we associate them with the long-term goals. But for shorter-term goals, we can use debt funds also, right? And we're going to learn a little bit more about that. So one must look at SIP for short-term goals, and they were likely to have smooth cash flows and keep long-term goals on track. So what fixed income funds can do in short term? Let's look at it. I think what we are going to do today is we are going to compare recurring deposit, ultra short duration fund. It's a category of a debt fund which invests in 6 to 9 months papers. And then you have low duration funds which invest up to a year, little less than a year. Okay. So we're going to look at returns over a longer period of, over shorter period of time. We're not looking at a longer duration, we're looking at a shorter duration. So a recurring deposit, ultra short duration and low duration, in a 6 months could give you a return like 3.5. Ultra short can give you 4.28, and a low duration fund can probably go as up to 6.5%. And this is basis data, which is a return as on 31st December 2020. We all know that the returns can change point to point depending on what periods are you taking, right? So we are just taking it about from a last calendar year completion. Now, if you look from a 9th month period, if you would have invested for 9 months, what would have happened? Then the rate was about 4.4, ultra short was 5.5, low duration was about 7.55. This is historic average returns that we have taken. If you look at 1 year period, then the recurring deposit was about 4.9. Ultra short was about 5.64, and low duration would have gone from 7.34. So you can clearly see that stepping over from a bank product, coming to a mutual fund product, which is the ultra short duration funds or the low duration funds, is actually increasing your returns. Yes, a little bit of risk also increases, because in the bank deposit, you know that it is secured up to a lakh of rupees. Here, there is no assurance of return. There is nothing which is guaranteed. But you can clearly see that there is a higher return which can be generated, almost up to the range of, you can clearly see right now that the difference between recurring deposit and ultra short is about 10 basis points, about 100 basis points. And between on the 1 year, it is as high as about 60 basis points. So you can clearly see there is a difference. Now, let's look at SIP returns in these categories. And we are also going to add large cap funds here to give you a flavor of equity. We are also going to add dynamic fund and gilt fund, which are largely volatile, so give you a same comparison like equity. So a recurring deposit over a 3-year SIP return, again calendar year ending December 2020, recurring deposit over 3 year would have probably given you 5.15. Large cap funds, which is equity, would have given you about 7.61. A dynamic bond fund, which plays on the duration of the product, would have given you 7.9. And a gilt fund, which invests in the 10-year papers of the government securities, largely, would have probably given you 9.65, right? So you can see over a 3-year period, what is the difference if you just jump into the debt funds. Of course, one needs to understand the risk appetite of each of the person and also look at whether those funds are favorable for you or not. If you look at from a 5-year perspective, if you would have done doing SIP in 5 years, then a recurring deposit would have given you 5.3, equity would have given you 10.7, dynamic funds would have given you 7.64, gilt would have given you about 9%, right? So you can clearly see as the duration has increased, then the equity portion starts playing out. But for shorter durations, the debt funds are actually doing slightly better, right? So even though we saw a previous slide where we showed you up to 1 year what is happening, now we are showing you between 3-year to 5-year what is happening. And we can clearly see that the return differential between the large cap fund and the gilt fund is not very large. So you have two different asset classes again, equity and debt, and you're seeing GSEC, and you're seeing return which is say about 10.7 and 9.3. So you probably had before this session, you must be wondering that debt funds probably do not give higher returns, but we are seeing the returns which are single digit but closer to double digits, right? And why does that happen? Because there is enough volatility in the debt market which is happening as compared to what is happening in the equity market. Both are volatile. Equity is also volatile. Debt is also equally volatile, right? Now, I'm just taking a pause here. I'm just reminding everyone that we have a Q&A session that we'll be taking towards the end of it. So far, whatever you've seen If you have any questions, there is a question box right below the video panel. You can post in your questions, and we will try to, whatever time permits, we will try to take as many as possible. Right? So coming back to the presentation, we are looking at volatility which happens in equity, volatility which happens in debt. Again, here you can see how volatile the segment is in terms of this is the GSEC yield, which is the orange color line, and you can see that the rates have started to come down as because last year we had pandemic, so rates were cut. AAA corporate bond 10-year, again you would have seen volatility. Again, from a AA corporate bond, you would have seen volatility, right? So debt investing is about combination of GSEC, corporate bonds, highest yield papers, one notch below papers, and even riskier instruments like credit risks. But I think we are not getting too much into those product categories. Maybe we'll have a separate session on each of those categories. Today we are restricting ourselves on the SIP concept, right? So how volatility helps? I think it's a very self-explanatory slide, and we have borrowed it from one of our equity presentations, where you can clearly see that if you keep investing equal amount of money across the year, the volatility in NAV will also be there. If today you're looking at this NAV of an equity fund, the similar can be there for a debt fund also, right? And you will keep accumulating units, and as the performance of the underlying NAV goes up, you will realize a larger gain from, right? So it's a great concept which you're using on equity side. You can use the rupee cost averaging concept for debt funds also. Now, like we said, summary of whatever slides we have seen so far, that SIP in debt and volatility is just like equity, and the similar concept that you used for rupee cost averaging on equity can also be used for debt. Now, let's look at if we adopt this principle of doing equity investing or debt investing and SIPs in this, what is the benefit that we are going to get, right? Because two things are going to happen. One is you're going to invest in two different asset classes. So of course you're doing asset allocation. Second, it will reduce your portfolio volatility, right? So now let's look at it. First, let's look at a 3-year SIP return if you would have been investing in Sensex, right? So you can clearly see the volatility of how it is being moving. And we saw last year, this is the pandemic period of March 2020, how the markets corrected. And then we saw the bounce back. But you're seeing great volatility happening. Now, if you would have done a 3-year SIP on a composite bond fund, right? Then your volatility aspect is not as volatile as probably equity was, right? It has largely remained in a straight line, or you can say a little upward trend. Now, imagine if you do a SIP, say you are doing 10,000 rupee SIP per month, you break it into two, you put 5,000 into equity, you put 5,000 into a bond, then what happens? Your portfolio volatility reduces drastically. So while in March 2020, you went down negative, you probably wouldn't have gone negative, right? If you would have split the investment into two, right? So by doing SIP in both equity and debt, what we are observing is there is increased amount of it will decrease your volatility. It will decrease the volatility because of a good asset allocation that you're going to do, right? Rather than just sticking on one of the assets. Now, let's look at SIP in debt funds return vis-a-vis the repo rate, because we know repo rate plays a very important part in terms of determining what is the interest rate cycle. So if you look at the repo rate in the country from December 13 till December 20, we have come down drastically from a high double digit to now coming down to say a lower single digit, correct? and what impact that has on a SIP of a debt fund, correct? So we are now putting you on an average XIRR return of a 3-year SIP in a debt vis-a-vis the repo rate movement. So you can clearly see when the repo rate was in an upward trend, or sorry, if it was in an upward trend or a flattish trend, which was about 10%, the debt returns were slightly muted, right? It was about 7%, 8% during those times. As the rate started coming down, you can clearly see between June to say about September 17, the return started going up. And that's what happens. This is something which people have probably need to spend a little bit more time understanding that as the interest rate starts moving down, if you're holding a paper which is of a higher interest rate, and if the interest rate tomorrow is lower than the paper you have, then the value of this paper actually increases, correct? And that's how your return goes. And I promise you we'll do one session on that sometime later, where we'll talk about how does interest rate affect the bond movement. Then going forward, you see again a trend line, straightish line. You see the SIP returns a little bit lower. And then as today, as the interest rates have come down and it is now at 4%, we are seeing the SIP returns have again gone up because there was a cut in the interest rates. So whenever there will be a cut in the interest rates and you're doing SIPs, the bond prices will increase, the value of that will increase, and you will get a better SIP return in terms of your NAV performance. So SIP in debt is also working in similar principle as equity markets. The factors influencing equity market SIPs are different. The factors influencing debt market SIPs are different. And one of that thing is for all of us to know is we are seeing a continuous decline in the bank interest rate, right? We have seen the highs of 10%, 9%, 8%. Now we are seeing 6, maybe sub 6 in certain cases. So while, and we've seen in the previous slides that as the returns have started coming down on bank interest, we are seeing differential return in debt funds going a little higher. Again, in a fixed deposit, your income, if you hold for 3 years or 5 years, anyways, it's 5 years if you want to take the ATC benefit. But if you're holding for 3 years, then the income that it comes, the interest which is generated adds to your income, and you have to pay a tax on that as per your income slab. But in case of a debt fund, you have benefits on taxation. If you hold it for 3 years, you can get a indexation benefit. The resultant your net outflow on the tax on the returns that you get is slightly lower as compared to the bank returns. So in terms of comparison between recurring deposit and SIP debt, you can see that a recurring deposit is slightly lower on, it's lower on the risk element, but also lower on the rate. And you can start in small amounts. If you're coming to the debt funds, then you have products which are based on tenure, on the risk appetite. They are market linked rates. They can be started with small amounts, and you will definitely benefit from the interest rate movements as and when the product happens. Now, I'm sure some of you are thinking right now that, look, we have seen cycles in the past where the interest rate movement goes up, resulting in maybe a lower NAV or maybe interim loss, which is again like equity. You may invest something and the valuation is down. The same way is on the debt fund also. But more or less, if you stay through the entire course, which is at least 3 years, 5 years, you will probably end up getting a decent return as per the economic cycle, right? So how do you choose debt funds for SIPs? Depending on the goal. So if you're looking for shorter term goals, then we'll request you to look at fund categories like ultra short-term fund or a savings fund, or a money market fund, which is up to a 1 year investing. If you're looking at a medium-term goal, then you look at short-term fund or a banking and PSU debt funds or a corporate bond funds, which generally invest between horizons. So short-term would be between 2 to 3 years, banking and PSU and corporate would be from 3 to 4 years. And if you're looking for a long-term goal perspective, then you should opt for a dynamic bond fund or a gilt long duration fund, because there the interest rate cycle, the way they play out, would be uh, would be in favor, right? Investor journey, we are just giving a snapshot. We are not advocating that this is the right method for you, but from a risk reward return perspective, one must move in this manner. Look at, if you don't want no risk at all, then you should stick to bank FDs. You want a little bit of risk, you need to understand debt market, have an experience, come to the liquid ultra short term categories, where you would get something which is slightly better than your recurring deposits. If you want to be invested for 2 years, 3 years, take a little bit of more risk. You should go to short and medium term funds. If you want more, you want to invest for longer periods, take higher risk, then you should go for long term debt funds. Or if you want a combination of two, you can look at hybrid funds. Hybrid funds come in both categories, equity heavy, debt heavy, and then ultimately you should move to equity fund. Of course, all of these need to be kept in mind with what is your risk profile, what are your requirements, what are your goals, and how you should be moving in line accordingly. So as a conclusory side, debt as an asset class is likely to work for short-term goals in the short term and long-term debt for long-term goals. So you choose your goal first, establish that, and then opt for the product that you would like to go for. Like we said, equity usually works well for long-term goals. For short-term goals, you should consider the debt products. Again, long-term debt SIPs in products, short-term products will help you achieve short-term goals with annual cash requirements. Savings behavior will be inculcated. And we saw that if you think equity is volatile, even debt is volatile. But we also saw that over the last 10 years, ending 20, ending 19, that the returns of whether it's the debt products, the underlying returns of the debt products or the equity products are now coming closer to each other. The difference is narrowing by each passing year. And that's where we will request you to look at debt funds also as a viable option, and SIP as an option to look into investing in a systematic manner. So that's all for today. I thank you all very much for joining us today on this special awareness program on SIP in debt. We hope that you have enjoyed this session. Our Twitter handles are there, our Facebook pages, our YouTube. You can search Mirror Asset. If you like this, please do give your feedback on this. We'll be happy to listen in. My name is Shrinivas Khanolkar, and it was a pleasure hosting this session with all of you today. Thank you very much. Stay safe. Goodbye.